On October 10, 2025, the world of cryptocurrency was shaken to its core by a flash crash of historic proportions. What began as a seemingly ordinary trading day quickly spiraled into chaos, as digital assets across the board began to plummet at an unprecedented rate. The news spread like wildfire, with headlines flashing urgent warnings and social media erupting in panic. In just 25 minutes, altcoins plunged 33%. Wiping out a staggering $560 billion in market capitalization. The speed and scale of the collapse left even seasoned investors stunned, as entire portfolios were decimated before their eyes. For many, it felt as if the ground had disappeared beneath their feet. Over $18 billion in leveraged positions were liquidated instantly, leaving traders powerless to stop the bleeding. Margin calls and forced sales triggered a cascade of losses, amplifying the panic and accelerating the downward spiral. For those who had bet big, the consequences were immediate and devastating. Bitcoin, the market's anchor, was not spared, but it was the altcoins that suffered the most catastrophic losses, some dropping over 80% before any signs of recovery appeared. Projects that had been household names just hours before were suddenly on the brink of collapse, their communities left reeling. Investors watched in disbelief as their portfolios evaporated in less time than it takes to brew a cup of coffee. For many, years of gains were wiped out in mere minutes, leaving them staring at screens in shock, unable to process the speed of their losses. The emotional toll was immense. Fear, confusion, and regret swept through both newcomers and veterans alike. Some broke down in tears, while others sat in stunned silence, trying to make sense of what had just happened. The sense of vulnerability was palpable, as the reality of risk in the crypto world hit home. The event was a brutal reminder of crypto's unique risks and the speed at which fortunes can change. In a market driven by volatility and speculation, even the most experienced traders can be caught off guard. The crash exposed the fragility of the system and the dangers of over-leverage. In the aftermath, the industry was forced to reflect on its vulnerabilities and the ever-present potential for devastation. Regulators, exchanges, and investors all began to ask hard questions about risk management, transparency, and the future of digital finance. The storm had passed, but the lessons were just beginning. For those who survived, the crash would serve as a lasting reminder. In the world of crypto, nothing is ever truly certain, and resilience is the only way forward. Every crash has a trigger, a single moment or event that sets off a chain reaction. But what really causes a market to unravel so quickly? It's rarely just one thing. It's a combination of factors, all waiting for the right spark. In this case, it all began with a single social media post that went viral in minutes. The post spread like wildfire, instantly reaching millions of investors and traders around the world. In today's hyper-connected world, information travels faster than ever, and so do panic and fear. Former President Trump's threat of a 100% tariff on Chinese imports sent shockwaves through global markets. The announcement was unexpected, and it immediately raised concerns about a new trade war, supply chain disruptions, and the potential for economic slowdown. Crypto markets, already fragile and overloaded with leverage, reacted instantly. Prices began to plummet within seconds, as algorithms and traders scrambled to adjust their positions. The volatility was unlike anything seen in months. The market's thin liquidity and excessive risk-taking created a perfect storm. With so many investors betting on borrowed money, even a small drop in prices could trigger massive losses. As prices fell, automated liquidations kicked in, forcing the sale of assets at any price. This triggered a vicious cycle, accelerating the crash as more and more positions were wiped out. The domino effect was relentless. The real issue wasn't just the tweet or the tariff threat, it was the market's underlying weakness and extreme leverage. Many investors had ignored the risks, believing the bull run would never end. This event exposed how quickly global politics can impact digital assets. In a world where markets are interconnected, a single political statement can ripple across continents in seconds, affecting everything from stocks to cryptocurrencies. The crash was a wake-up call. Crypto's structure is only as strong as its risk management. Without proper safeguards, the entire system is vulnerable to sudden shocks. In the end, the fire was lit by one spark, but it was fueled by collective greed, unchecked risk, and the speed of modern information. The lesson? In today's markets, it only takes a moment for everything to change. The October crash split the crypto market in two, sending shockwaves through both seasoned investors and newcomers alike. It was a moment that tested the conviction of everyone involved in digital assets. Bitcoin, the original cryptocurrency, dropped sharply in the initial panic. Yet, despite the volatility, it managed to maintain its long-term bullish structure. For many, Bitcoin acted as a relative safe haven, weathering the storm better than most expected. Its ability to hold key support levels reinforced its reputation as the most resilient asset in the crypto space. Altcoins, however, faced a bloodbath. Major projects like Solana and Cardano fell 30%, erasing months of gains in just a few days. The sell-off was swift and brutal, leaving many investors reeling from the sudden losses. Some smaller tokens fared even worse, with losses exceeding 80%. These dramatic declines wiped out entire portfolios, highlighting the extreme risk that comes with chasing high returns in the altcoin market. Cosmos, for example, experienced a shocking flash crash, briefly plummeting to a single penny before rebounding. This wild price action underscored just how unpredictable and illiquid some altcoins can be during market turmoil. In the chaos, investors scrambled to protect their capital, fleeing altcoins for the relative safety of Bitcoin. This mass exodus caused Bitcoin's market dominance to surge, as it absorbed capital from across the crypto ecosystem. The crash shattered key support levels for many altcoins, breaking not only their technical charts but also the confidence of investors who had believed in their long-term potential. For some, it was a harsh lesson in risk management. Rebuilding trust in these assets will take time and a sustained period of recovery. Many investors are now re-evaluating their strategies, waiting for signs of stability before considering a return to the altcoin market. The event highlighted the risk spectrum in crypto. Bitcoin, often called digital gold, proved its status as a store of value during uncertainty. Meanwhile, altcoins once again showed themselves to be high-risk, high-reward bets, capable of both incredible gains and devastating losses in short periods. In times of panic, the market instinctively seeks safety in the most established asset. Bitcoin stood out as the clear choice, attracting capital and attention as altcoins faltered. The divide between Bitcoin and altcoins has never been clearer, reminding everyone that in crypto, not all assets are created equal. After the crash, crypto prices rebounded. Bitcoin reclaimed $114,000, Ethereum rose above $4,100. Many hoped the worst was over, but seasoned traders warned of a dead cat bounce. This pattern, a brief rally after a crash, often lures investors back in before another drop. The bounce is driven by bargain hunters and those desperate to exit at better prices. It preys on hope and FOMO, tempting people to buy before the market resumes its decline. True bottoms form over time, not in sharp V-shaped recoveries. The current rebound lacks volume and hasn't reclaimed key technical levels. Without strong confirmation, the market remains vulnerable. Don't mistake relief for recovery. Caution is still warranted. This bounce is especially dangerous because it feels like a return to normal. Altcoins, in particular, are showing classic bearish patterns, bouncing up to resistance, not breaking through. The total crypto market cap remains below the crucial $3.65 trillion level. Unless this level is reclaimed, the bounce is likely just a temporary relief rally. The market's technical structure is still broken, especially for altcoins. Smart money uses these bounces to exit, while retail investors get trapped. The real risk isn't the crash, it's the deceptive rally that follows. Stay alert. Hope can be a trap. In this volatile market, focus on the data, not the noise. Watch the total crypto market cap. $3.65 trillion is the key resistance. For Bitcoin, monitor the 365-day exponential moving average around $100,000 and horizontal support at $94,267. A break below these levels signals deeper trouble. Bitcoin dominance is another critical indicator. If it rises while prices fall, altcoins are in danger. Money leaving altcoins for Bitcoin, or out of crypto entirely, signals a risk-off environment. Also, keep an eye on the VIX, the equity market's fear index. Historically, the best crypto buys come after the VIX peaks and falls, not while it's rising. These levels and signals matter more than daily price swings. Let the data guide your decisions. In times like these, focus on capital preservation, not chasing gains. Avoid leverage. Recent events proved how quickly it can wipe you out. Stick to spot trading and consider holding cash or stablecoins for flexibility. Patience is key. You don't have to be fully invested at all times. Use dollar cost averaging to reduce risk, buying in small amounts over time. Diversify, but remember, in a crash, most altcoins fall together. Define your entry, exit, and stop-loss points before trading. Don't let fear or greed dictate your moves. A clear plan and discipline are your best defenses. Survive now, so you can thrive later. Behind every crash are real people facing real losses. The pain is a harsh teacher. Risk management isn't optional, it's essential. Only invest what you can afford to lose and never rely on hype or leverage. Education and independent research are your best tools for survival. Crashes force hard questions. Do you understand what you own? Are you investing for the right reasons? The survivors are those who learn, adapt, and build conviction through knowledge. Painful as it is, this reset strengthens the market's foundation. The lessons learned now will shape smarter, more resilient investors. As the dust settles, uncertainty reigns. Long-term potential remains, but the short-term is risky, especially for altcoins. The best tool now is patience. Wait for confirmation before acting. Don't gamble on a quick recovery. Let the market prove itself. Use this time to refine your strategy and research quality projects. If prices fall further, be ready to buy with conviction, not panic. If a true uptrend emerges, deploy capital with a clear plan. Every crash clears the way for the next wave of innovation. With caution, education, and patience, you can avoid the trap and thrive in the next chapter.